It's time now for Smart Charts with Abigail Doolittle, where we look at the timely topics with the street's top technicians. And Abigail, you're starting with the S&P 500, yet another record high.
Yeah, Caroline, it's really pretty amazing. The S&P 500 yesterday, an all-time high. Today, a record closing high. To talk more about the S&P 500, those record highs. Other asset classes, Katie Stockton of Fairlead Strategies, thank you so much for joining. And
of course.
You have a bullish view here. This is a monthly chart, so talk to us about whether or not you think that this breakout is going to continue and where you think it might be going.
Well, really, breakouts tend to be very bullish for the market. They remove resistance from the chart, so that's a good thing. And also they reflect positive momentum. So the last major breakout that we had like this was in 2016. Preceding that breakout, we had a trading range that was characterized by a lot of downside volatility, and I would argue that we're advancing from the same kind of situation right now.
And that proved to be pretty bullish.
It was. So you saw a nice follow through in 2017, of course, and then entered this sort of consolidation phase, if you want to call it that. Now advancing to new all-time highs. The breadth is very positive on this move, meaning that we're seeing good participation on the rally. And like I said, it does reflect positive momentum. So from a technical standpoint, it's a good thing.
So in that case that you're using, that previous example, it looks like we went from roughly a little bit above 2,000 to a little bit below 3,000. If you're going to play this forward, I don't know if you're willing to share a target, but how high do you think we could go by the end of the year, 12 months forward, or
it actually goes back to that breakout to derive a measured move projection.
Okay.
So it really assumes the trajectory of the trend will maintain itself.
Okay.
And that breakout in 2016 yielded a very long-term target of about 3280 based on that measured move, and that still to me is valid.
Could you see that happening by the end of this year, or more?
I'd really say in the next 12 months or so.
Okay, great. So now let's take a look at your 10-year yield chart. I love this chart. It's been a little bit frustrating to me, some of the technicals here, but I love this cloud that you have in here.
Well, right. So the cloud shows the downtrend that 10-year Treasury yields have been bound by really year to date. We had the breakdown in Q4, of course. Now, as it's come down, made lower highs, lower lows, we have actually seen very recently a loss of downside momentum. You can see it there in the bottom. It's a crossover in something called the MACD indicator, which is a moving average-based gauge, and that shows the loss of downside momentum right as the 10-year Treasury yield comes into potential support around 2%. That's, of course, a very psychologically significant level. So I think we have to defer to the downtrend, but I think there is a good chance that we see some stabilization in here around that 2% level, given the loss of downside momentum, and that would then preserve very important long-term support back from 2017 and prevent a breakdown that would target about 1.4%.
Yes, I was just looking at this chart today and over the last couple of weeks, and a daily chart similar to this, but using the 50-day moving average, and basically a range suggests that there could be a move if that stabilization continues to hold back up toward 2.3%, and that's somewhere around the bottom of that cloud, somewhere in that cloud. Could you see that, or do you more see just
exactly right?
It?
And I think we have to assume it's a short-term counter-trend move that would unfold until it proves otherwise. Resistance is a bit of a moving target based on that model, but if you look out to about mid-July, it ranges from that 2.2% to 2.3% area, and I think that seems pretty realistic for a counter-trend move.
Okay, so now let's go global with the equity markets, and Mark Newton was here earlier. He was talking about the Nikkei, as you know. You were just having coffee with him.
There's a reason we're both talking about it.
Yes.
So we've finally seen a little rotation into Japanese equities. You see it in the Nikkei 225 with the breakout there above the yellow line, which is an approximation of the 200-day moving average. At the same time, it's coming off of what was an intermediate term oversold condition. You can see that in the bottom window there, and that rarely happens. You can see it happens about twice a year over history. So it's a big deal from a technical perspective. I do think the renewed momentum there on a short-term basis could unfold into something more meaningful. Of course, the Nikkei 225 is not without resistance on the chart, unlike the S&P 500, so it has more challenges, especially from a relative perspective still. But nevertheless, this breakout above the 200-day moving average, plus that oversold buy signal, if you will, is pretty significant.